Good afternoon, Quasar Markets Live. I hope everyone's having a wonderful St. Patrick's Day. Dr. Ellman, how are you doing today?
Good afternoon, Howard. Good to see you again.
Always a pleasure, sir. Been pretty hectic in the markets. We've seen a few positive days. You have any thoughts on the market in general? You think we finally sort of found a bottom here, trying to work our way back up?
Well, that depends on how long these new responsibilities are regarding tariffs.
Yeah.
If they remain, I think that we're going to continue to see a lot of volatility, a lot of uncertainty, a lot of chaos, and that's never good for the market. So
Right.
once those are taken off the table, I think we'll be good to go and get some recovery going on.
And are you trading any differently right now with your positions? I know Monday is usually a big day for you to sort of recalibrate and reassess your positions. Are you doing anything differently, or is it, going ahead as normal?
No, I am doing things differently. I'm taking more defensive posture to my trade. So,
Okay.
for example, when I do a covered call, typically in normal to bull markets, I'll sell an out of the money call, providing me with the opportunity to generate two income streams, one from the option premium and the other one from share appreciation from current market value up to that out of the money call strike. So, two income streams. If there's a dividend, it might even be three. But because of the uncertainty and volatility of the market, I've been selling only in the money calls, and in the money
Okay.
strike, as you know, have an intrinsic value component to them, and therefore the break-even price points are much lower. So for covered calls, I've been doing in the money calls, and for cash secured puts, if the price is here, I'm going to sell a deeper out of the money cash secured put, generating smaller returns in return for greater protection to the downside. So yeah, I've definitely changed my strategy approach, although I'm using the same strategies.
Right. Absolutely. I just wanted to ask that question because I did assume that was probably the case, based on the way the market's moving, and absolutely is. Today, you have a great one because this is the time to me where a lot of people are going to start to get back into markets. They're going to start to reallocate some of this money that's been on the sideline. And you want to show everybody how to buy everything at a little bit of a discount. Is that correct today?
Everybody loves a discount, right, Howard?
Except for when Bitcoin's on sale, like it's been lately, no one wants to buy it. They only wanted 100,000. Same thing with Nvidia. No one wants Nvidia at 115 or 110. Everybody wanted it at 150.
Hey, Howard, how did I know that we get back to NVIDIA and Bitcoin in this discussion? How did I
Yeah,
know
always tend to, don't we?
that? Yeah, we're going to talk about a strategy invoking an SEC rule made for us, for retail investors, on how to negotiate better prices with these market makers when we're buying or selling options. So when we're using these low risk option selling strategies, and I've made it clear in our 20 plus discussion so far that my sweet spots are covered call writing and cash secured puts. And our goal is to generate cash flow, money. We're generating money. That's step one. We click the button on our computer keyboard and the cash is in our account. So that's step one. But how do we know what price to accept or what price to ask for? Well, these option prices are published in option chains. So it's just a price list for the various options available per any one security.
Right.
Now we would sell at the bid. That's what I do. I'm on the sell side of options. We sell at the bid, which is the lower price on the option chain. I'll be showing that shortly. And if we were to buy an option, we would buy at the ask price. So the difference is known as the bid ask spread. And that difference, that spread, is enjoyed by the market makers because they make more money the wider the spread. And that's why the SEC put in this show or fill rule, which gives retail investors like us the opportunity to actually negotiate better prices with these market makers.
Right. And before this rule came, it was basically there was no, there was always the range, the spread, but you couldn't take advantage or negotiate in the old days, right?
Right. We didn't have any bullets in our gun to negotiate. Now we do. We absolutely should take advantage of it.
Absolutely.
So Howard, in this screenshot, I'm showing two examples. The top one of your favorites, iShares Bitcoin Trust, listed on the NASDAQ, IBIT. When I made this screenshot a couple days ago, it was trading at 44.91. So if you take a look in the yellow cells on the right, top right, those are the strike prices that we could sell the calls at. 44 to 49 are the ones that I showed. There are certainly a lot more, but those are the ones that are pretty close to the current market value. Now, if you look in the pink column, Howard, you'll notice the interest. That's the open interest or the number of open contracts at the moment that I made this screenshot. And you can see they range from like 300 up to 8,000. So there's quite a bit of interest. Not only you, Howard, but with a lot of other investors.
Not just me making the market.
You didn't cause this option chain by yourself. There were definitely others involved.
Yeah, for sure.
So I wanted to draw your attention to the open interest, because when there is good liquidity with an option, that means that the spread between the bid and the ask is going to be much tighter, which means much favorable to our price execution trades. So if we could sell an option at the bid, what if we want to buy it back? If that spread is very tight, we'll get a very favorable trade execution. So have a look at the brown cells on the top left, and you'll notice that the difference between the bid and the ask ranges from like 10 cents on the top with that 44 strike. And then if you look at the bottom, the 49 strike, that's 7 cents, $2 to 207. So that's an example of a very highly liquid option chain that if we felt that this was a great performing underlying security from the vantage point of liquidity of the option, it would definitely be something I'd be interested in. And I actually been trading options on this for the last couple of months.
Yeah.
Now, take a look, Howard, now at the lower one, Palomar Holdings, Inc., listed on the NASDAQ PLMR. And again, this was just a couple days ago, and it was trading at 126.09. Now, the strikes I selected were a little below and a little above that 126 current market value price. Now, look in those pink cells to the left, and you'll see the open interest. What a difference between IBIT and exactly. It ranges from like 2 to 19, quite a difference. What does that mean? Well, we don't even have to look at it. Right off the bat, we know that the bid-ask spreads are going to be humongous. So if you go to the closest one to the price, to 125, that's 550 to 1020. What is that? 470 as opposed to 10 cents to 7 cents on IBIT. So actually, Howard, this would be an example of a security that I would never use for options. I may want to own the stock.
Right.
I may own the stock, but I would never use it as an underlying for options, because if I tried to manage the trade by buying back the option, I would get killed on that spread. And even using the show or fill rule, I could not mitigate spreads that far apart. They would have to be much closer together for this show or fill rule to be effective.
And I'll point out again that so many traders don't understand that. I can't tell you the amount of times that I've had people come to me and say, hey, I'm in stock XYZ. It went up tremendously, but I can't get any fills on my option, my calls I have. Well, I go look, and there's only 3, and they own all 3. You know, and there's no liquidity there. No one wants to buy it, you know, especially when you see people that try to play with these lotto plays that are way outside of the money.
I think it's important when you're doing strategies like I do, it's important to evaluate the liquidity of the underlying stock itself and the liquidity of the option. You have to have certain rules and guidelines as to what you think would be appropriate, and then move forward from there. Because if you were to enter a covered call trade with PLMR, and then all of a sudden you were faced with a scenario where you wanted to buy back that option, at that point in time, you would learn your lesson. You know,
right. Like you said, there could be a $5 move just based on the bid ask, not even on the price of the underlying asset.
Exactly. So, yeah, look at the liquidity, and then you'll know whether or not that's appropriate for options. So
it says, what is the show or fill rule?
Okay. Well, it's also known as the limit order display rule, and it's a strategy that you could use to negotiate a better price with the market maker. Now, all you have to do is when you look at the bid-ask spread, is to put in a limit order, which means a specific number, which the broker must fill or better, must be that number or better, that improves the market. And improving the market simply means somewhere between the bid and the ask. But there's a very specific way that we have to do this to make this an effective strategy. So what we do is we find, and I'll go into this in the next slide, but we find the midpoint of the bid-ask spread, and then we drop a little bit below that, and that's the limit order that we put in. Now, anybody, any retail investor out there that trades options should know how to leverage the show or fill rule, because I promise you this, not always, but a lot of times, it's going to end up putting cash in your pockets, and it's
Right.
going to take like a minute to do this.
Yeah. It's like what I would almost compare it to is, I have Capital One credit cards and I have on my websites where they go automatically to see if there's a code that saves you $2 or $3 on a purchase. And that's to me what this is like. You aren't just accepting the price that's out there. You're saying, hey, you know what? I love that trinket that you're selling me. It's like when my mother used to go to Tijuana. I love the donkey bank, but if I'm going to get one for my son, I don't want to pay $10. I want to pay $3.
Right, and it's something that's public information, the show or fill rule, and a lot of beginner investors are probably not aware of it, and that's why it was such a great idea that you have for us to talk about it today.
Yeah, I mean, I can't tell you the amount again that I noticed that at beginner traders that make market orders on things, and it makes my skin crawl. Like at almost no time, in my personal opinion, and should you really be using a market order, you should always be at least setting a limit order, and then, like you're saying, in this case, trying to negotiate your option price.
Yeah, and as you'll see when we go through some specific examples, the worst case scenario is you end up with the bid price.
Right.
But most of the time, as I said, you're going to do better. So here's a real life example with Viva Systems Inc. listed on NASDAQ VEEV. Now you could see here on the top that at the time I created this screenshot on 3/11, so yeah, just a few days ago, it was trading at 239.63. So I was looking for, if I were doing an out of the money call, which strike I might use. And I can kind of do the math quickly in my head. And but the spreadsheets we have can also do this for you. I would look at that 250 strike, out of the money strike. Yep. And you could see the spread ranges from 610 to 670. Now the open interest is 304, so that's pretty decent open interest. Not like IBIT, but pretty darn good. Now a 60-cent spread, Howard, is something that I can work with, and I automatically do. I don't even think about putting in a market order here. So right. Here's how you do it, and this I found to be the most effective way to leverage the show or fill rule. Step one is to find what's known as the mark of the spread, which simply means the midpoint. So the halfway point between 610 and 670 is 640. Now, I don't put in 640. What I do is I drop it down a couple of pennies to favor the market maker. It just gives me a little bit of an edge that this trade will actually be executed. Right. So we put a limit order in at 635 as an example, right? And it's a day only, not a good until canceled order. You'll see it on a screenshot of a broker form that I created in the next slide or two.
Okay.
And that's what you put in. Now, if you put in 635, now the market maker gets this trade and they go, okay, old Alan over here is doing 3 contracts of Viva 650 at 635. This is what their dilemma is. They could reject it, right? And then they have to change that spread 610 to 635 instead of 670. Well, that's a much slimmer spread. They make the
Right.
most money with the widest spreads. Or to get rid of me, just to get rid of me, they'll execute the trade at 635 and keep the spread at 60 cents, which
Right.
is more likely as to what's going to happen.
Yep.
Now,
They
one,
selectively choose which ones to fill in and not fill, so to speak.
yeah. I mean, if somebody's doing a humongous number of contracts, they might tend not to fill it and just change the spread. But most retail investors like me are going to do somewhere between 3 and 10 contracts, in which case, most of the time, let me just get rid of Allen and keep my spread nice and wide.
Right.
Now, there's one important thing that I have to say. Hopefully more, but for right now, one. Uh, some broker platforms have a little box on it that's known as the all or none or
Right.
AON box.
Yep.
If you shouldn't check that. If you check that box, now the market maker is no longer beholden to the show or fill rule. So
Right.
do not check the AON box if it's on your broker platform. And so this is a strategy I use all the time, Howard, for any spreads greater than 10 cents.
Absolutely. I would also like to point out here, you talked about how much, the liquidity in the interest in their, the open interest. You can see it here when you look at this 210 spread, there was only 31 options, and you can see how that bid ask. So just reinforcing what you were saying earlier, you can see how much tighter it is when there's 304 contracts versus how wide it is here with only 31 contracts. I just want to reiterate that even on this one that we're looking at, that's the case.
Yeah, and to take it a step further, Howard, the deeper in the money you go, or the deeper out of the money you go, the less liquidity there's going to be, and the wider the spread.
The spread in general, right? Absolutely. And as you were talking about, usually when you look at your brokerage form, this is what you're taking a look at.
This is how you would set up that trade for 635. So if you look in section 1 on the top left, you just enter the ticker symbol and what option your strategy you're using. In this case, you're doing a call. And then section 2, well, what do you want to do? I want to sell to open. You want to initiate a sell to open trade. You're not buying the option. You're selling the option. And how many contracts? Well, I just put in one. Usually I do more than that, but whatever the number is, you just enter that. That's section 2. Now you drop down right below that into section 3, and there you put in the limit order. Okay, not good till you put in a day order, not good till canceled, limit order at 635. How did we get that? We found the mark and dropped down a few pennies.
Yep.
Now, if we move over to section 4, there are drop downs there. So the ticker symbol will automatically transfer from the section 1, and the call will automatically transfer from section 1. You use the drop down to indicate what the expiration date you're looking at. In this case, it's 4/17. And then you also use the drop down to determine which strike you're using. In this case, it's the out of the money 250 strike. And so that just plays into what we just looked at before, the option chain for VEEV. Now you could see also with that oval area there, the bid-ask spread. Remember, it was 610 to 670, that 60-cent spread with the midpoint or mark at 640. So that just confirms the option chain. And then the arrow at the bottom right shows you how much cash is generated into your broker account per contract. In this case, it was one contract, so $635. Now, when you go to your cash account, it'll actually be something like $634.50 because there's about a 50-cent per contract commission on options. There's no commission on the stocks, but on the option side, there's commissions which will range anywhere from 50 cents to 65 cents. So little, so small that it almost doesn't pay to mention it. But there you have it. And so,
and I do want to point out when he says that, that's on the total amount. So it's not like per share. Sometimes people get confused because this says 635. Is it coming out of that 635? No, it's coming out of the $635, the total amount. So it's not a nickel per underlying stock. It's per the actual contract.
You're talking about the commission?
Yeah.
The
That is
commission is
not per share in this case. It's per contract.
per contract, correct?
Yeah.
Per
Some
contract.
people get nervous that that's going to, when I explain it, they don't quite understand. They think it's going to be, times 100.
No.
So what happens if the order is not executed? So that would be question number 1 that we have.
We don't give up. The fight goes on. So now the spread, and you'll see it in seconds. So you'll go to the option chain and you say to yourself, I did that. That was my limit order that caused that. So you'll see the new spread at 610 to 635. So what do? You find the mark, 622. Drop down a couple pennies. You put in a limit order at 620. Hopefully you'll get executed. If not, okay, white flag. I'll go with 610. And
so we go with a 3 and out rule there. Your third strike, you're out.
Well, I mean, at some point in time, you could see the market maker is just not willing to execute. But more often than not, much more often than not, we'll get the better price.
Right. Yeah, and I've noticed that over the years that it definitely that you do tend to. At first I'm like, they'll never take it, and then all of a sudden I started realizing, oh look, that got picked up. Oh, that got picked up. Oh, that got picked up. And like you said, it adds up when you continue. There it does get times by 100. So in other words, if you get in at 620 versus 610, that's 10 cents per share.
Yes.
So, that's going to be $100 on the total.
Well, $10 a contract if you have 10 contracts.
Yeah.
Yeah.
Absolutely.
But you know what? It's dinner out on Saturday night that'll take you about a minute to gain.
Absolutely, without a doubt.
And over a month, and then over a year, and over a lifetime of trading, it'll probably add up to hundreds of thousands of dollars.
Isn't it amazing just to think of it that way? And it's true, and it's what everybody would do. Do you look at, I know when I went yesterday to do my grocery shopping, I took a look at what was going on at Meijer. I took a look at what was going on in Kroger. I saw chicken was on sale at Meijer. I wanted chicken. I went to Meijer to get my chicken. I didn't want to buy it at $3.99 a pound. I wanted it at $2.99. So, we do it in so many different places, right? When we go to buy gas, we look at all the gas stations around us to go to the one that's cheaper. In this case, you're not usually going to find a difference between one brokerage or another. But what you can do is you can negotiate directly with the market maker, so to speak, to get your better price.
And it's so much easier than chicken shopping because you're sitting in front of your computer. You don't have to travel to a different store. All you have to do is just click on your computer a couple times. And you know what, Howard? It's kind of funny and interesting that even though you may not be talking about a lot of money, maybe $40, let's say, in one particular trade, even though you're talking about a small amount, somehow you feel really good about it.
You do. You just nailed it. I love when I get those, or if I'm looking at some sort of, other option, more, maybe a more advanced butterfly or something, and it's trading at XYZ. And I say, I want to be a little tighter than this. I think, it's trading at 290 for this contract. I think I can get it at 270. So I'll go a little bit out of the bid ask price maybe and leave it on for the day to see if I can get that fill, the same way any other limit order that I'm trying to do, whether it be on any other stock out there. And it's funny because I don't think enough people do it when it comes to options or realize that is still a function, that there is still the ability, so to speak, to negotiate price the same way we do with limit orders on, buying the underlying stock.
Yeah. So it's a gift from the SEC to retail investors like us. So why not take advantage of it?
Right, because they don't give us many. Usually they stack the deck against us and to the advantage of the market makers. This is one of the few times where you see something that the market makers did not like when it went through. I remember they were not happy at all. Made their life much more difficult, but that has made our lives better as retail traders.
But you know what? They still have their yachts, and
they still. I'm not worried about Ken Griffith. He'll be okay. I'm not worried about him or Jamie Dimon or any of these other folks. What we want to do here is protect the retail investor and give you the same advantages and insights, because I can guarantee you no large institutional hedge fund is buying with market orders. They are very strategic in what they're doing.
That's why this was such a great topic that you selected for today's discussion, because this is something that your viewers can implement now, today, right away.
Absolutely. Yeah.
I mean, you don't have to
For any
study.
trade, for no matter what. Again, this is what I love about this topic, and about the fact that you did this for us, is it doesn't matter what strategy you use. This is something that would fall into any of them, whether you use poor man covered calls and leaps, whether you use covered call, cash secured puts, like I said, broken wing butterflies, or you're just buying a stock. You should always be negotiating, is what I would sort of call this, your price, right?
Absolutely correct, Howard, and I appreciate the fact that you thought about this topic, because it'll benefit so many of your viewers instantaneously.
Absolutely. Well, Dr. Ellman, we want to thank you so much, like always, for joining us. As you mentioned, I believe this is our 21st episode. Wow. Please tune in and check out our YouTube channel, our X stream, to find them. I replay Dr. Ellman's interviews a lot because they are so key to the education that we're trying to teach here at Quasar Markets. His strategy has been proven over 30, 40 years. This isn't a fly-by-night new technique. He isn't telling you to play with 0 DTEs at a lottery machine. Dr. Ellman is, again, trying to teach you to do things that will make be more successful in trading and give you a leg up on your average retail trader. So thank you so much, Dr. Ellman, and we will see you next week.
Thanks, Howard. Take care.